Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for April 1st, 2018. And incidentally, happy Resurrection Day. He is risen. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 0.51 rose from 0.41 last week, advancing within bearish territory. The total count of securities in bullish or bearish patterns decreased 6% to 2,676. The count of bearish stocks decreased 12%, while the count of stocks in bullish patterns increased 10%. The Pirls PNF market breadth summary chart shows us a market now 9 weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 162 points for the 13th decline in 24 weeks. At a negative 2.89 points, it continues below all 9 tops in the last 30 months and continues above all 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 5 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on lower average daily volume. Momentum. The CCI 20 daily at a negative 120.31 is up from a negative 206.82 last week. At Monday, 326 close, it had 6 days below zero for a change of Woody's direction to down. It is currently outside the plus or minus 50 range for a valid zero-line reject short entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 100 weeks ago, while the daily CCI 20 began a Woody's downtrend this past week. The CCI 20 weekly declined to a negative 12.41 from a positive 13.03 last week, remaining within the plus or minus 50 range for a new zero-line reject long entry signal if the CCI 20 rises next week. Industry rotation the last 2 weeks. 3 of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: gold and silver, oil, and REITs on top. KBW Bank and some tech on the bottom. Bullish, REITs has entered the top 5. Brokers has left the bottom 5. Oil Services has left the top 5. Networkers has left the bottom 5. Bearish, KBW Bank continues in the bottom 5. Oil continues in the top 5. Semis, disk drives, comp tech, and computer hardware have entered the bottom 5. Gold and silver has left the bottom 5 and entered the top 5. Focus this week from www.maldeneconomics.com. Squares, Fangs, and Stock Valuations by John Malden. The following are some key points and charts. The FANG stocks, if you aren't hip to the lingo, consist of Facebook, Apple, Amazon, Netflix, and Google. Google's official name is Alphabet now, but it takes a G to make the acronym work. Whatever you call them, those 5 companies have ruled the technology sector the last few years and have wielded a heavy influence on the entire stock market. Apple is the world's most valuable company by market capitalization, with Amazon and Google not far behind. So anyone indexing U.S. large cap equities, which means almost anyone with investment capital, simply must own them. Owning the FANGs was a big help in 2017. Here's a chart my good friend Dave Rosenberg of Gleaned shared in his SIC presentation. It shows 2017 price returns for some selected asset classes. Last year, pretty much everything went up, but not equally. As you can see, the FANG stocks outperformed other stock benchmarks as well as gold, oil, and bonds, and not just by a little. If you are an equity portfolio manager who didn't own the FANGs last year, you probably had some explaining to do. But Dave went on to demonstrate why 2018 or 2019 could be quite different, using 4 different S&P 500 valuation metrics: forward price to earnings ratio, price to sales ratio, price to book value ratio, enterprise value to EBITDA ratio. The S&P 500 forward PE ratio has been below its present level 83% of the time since 1990. Repeating that exercise for the other 3 metrics and then averaging them, Dave found the index is presently at a 92nd percentile valuation event. Here's Dave from the transcript with my bold added. In other words, only 8% of the time in the past has the stock market in the United States been as richly priced as it is today. And if you want to come up with reasons why that's the case, that's fine. But just understand that we are extremely pricey. We're more than just a 1 standard deviation event versus the historic average. How is it that stocks rose the same amount on half as much economic growth? Dave said that if the stock GDP ratio today had remained what it was back then, the S&P 500 would be around 1,550 today. That's how excessive valuations are now. Here's another way Dave looked at it: household net worth as a percentage of disposable income. The higher that ratio, the more wealthy and confident you probably feel if you are anywhere near average, and many aren't, of course. In 1999 to 2000, and again in 2006 to 2007, the ratio was near a peak, and people felt good. The good feelings didn't last. Both times the ratio corrected back below its long-term average. And now, the net worth to income ratio is above where it was at those last 2 cyclical peaks. It could go even higher too, but not by much, I suspect, and the move down probably won't be fun. Whenever it happens, the next downturn will be something new. The first socially networked recession and bear market. It's hard to believe now, but Facebook and Twitter were both just infants in 2007. Smartphones were still a high-end luxury item too. We are now tied together in ways we were not back then. Those connections will make the experience quite different, so it's worth talking about networks. When new people join a network, they want to be connected to the most connected nodes. Secondly, once networks become economic propositions run for profit, it's winner takes all. And that is why 5 of the 8 richest men in the world today are rich because of network economics. Bill Gates, Jeff Bezos, Mark Zuckerberg, Larry Ellison, and Michael Bloomberg. In different ways, they all saw and exploited the value of connecting people via technology. This network revolution had a dark side, though, and we saw that dark side manifest in 2008. Very few central bankers understood the extent to which the international financial system had become a giant network. I think regulators and legislators underestimated the fragility of the system in 2008. They failed to see that a single node, a single investment bank that nobody regarded as pivotal to the system, was in fact very important. And when Lehman failed, the system, the entire global credit system, you remember? I remember, threatened to collapse completely. Andrew Haldane, chief economist at the Bank of England now, is one of the few central bankers who think about this, and indeed this slide was taken from a deck that he did in 2011. The way I see it is that since 2008, the rest of us have basically caught on with where the financial world was 10 years ago. Initially, it was only the financial world that was networked to the max because it was still quite expensive to be networked 10 years ago. But with the advance of giant platforms like Facebook offering zero-cost networking, all of us are now as connected as only investment bankers were a decade ago. Really pay attention to that chart. This is happening in literally hundreds of industries. These ubiquitous connections were supposed to empower everyone. Instead, they empowered those who owned and controlled the networks. A handful of platform companies essentially gained the ability to micromanage the village square, defining what information each person could see and hear. In fairly short order, the FANG companies leveraged that ability to dominate the global economy. Amazon is, in a sense, eating retail sales by making price discovery much easier. You can compare prices simply by running your phone over a barcode while you shop in a store. Similarly, Google and Facebook are eating advertising. Apple, Netflix, and their kin are eating leisure time. Our already weak form of capitalism has turned as monopolistic as it was in the Gilded Age, more than a century ago. It wasn't supposed to happen that way, but it did. Less than 2 months ago, GDP Now was predicting almost 5.5% real GDP growth this quarter. From there, GDP growth has collapsed all the way to 1.8 as of March 23rd. If the economy and markets are a mirror, we're starting to see a bunch of cracks. The Bitcoin breakdown looks ominous in hindsight as possibly the first domino. Then we had the February VIX-driven correction, followed by trade worries, and now FANG fears. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you have been enjoying a peaceful and pleasant holiday weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.